name is Andrew Petwain. I am the editor of insuranceinvestor.com, and it is my pleasure today to be joined by Corrado Pistarino, the CIO at Foresters Friendly Society. Corrado, how are you?
Hi, Andrew. Good morning, and happy to be here. Thank you for inviting me to speak.
Thank you so much. Corrado is a seasoned veteran of the Insurance Investor events, and we're so lucky to have him again speaking at our event this year in September in London. Corrado will be speaking on a panel discussion around how do you truly appraise and understand risk to set its foundations for strategic asset allocations to then invest at scale, which is a big, meaty topic with lots of angles and lots of things to discuss. So, Corrado, I am going to delve straight into the questions for you today. Can you discuss the macro landscape around this topic and set the scene for us?
Sure, absolutely. So the macro landscape, if you look at the global economic landscape for 2024, I think there are some common themes across developed economies, like a tight labor market and persistent wage pressures that, of course, translate into price pressures. When it comes to the growth element, there's a bit of a divergence between what happens in the US and what happens in Europe and in the UK. But in a way, as I said, there are a lot of things which are very common. If you look at the US, for instance, the most important indicators or macro factor to monitor, in my opinion, is what happens in the labor market. We have seen a lot of softening in the last few months, which is very positive, and the Fed would be very happy with that. But it remains a very tight labor market. So in this case, you can always see the half full or half empty glass, and probably on the half empty glass side of the argument, because yes, it's true that a lot of indicators like quit rates and have decreased, and unemployment claims, unemployment rate is ticking up a bit. But in general, the economy has been adding jobs quite steadily over the past 1 year, even more. And more importantly, if you look at the layoffs, you have not seen a significant spike in layoff. Actually, layoffs are less than they were in 2019. And so what happens is effectively, and unemployment is quite high. Unemployment is steady. So, employment is steady. So you have a bit of a tick up in unemployment, but in general, unemployment is quite steady. And of course, the two measures are computed against different bases. And so sometimes they converge and sometimes they diverge. So in general, if you look at the big macro pictures, the fact that the labor market in the US remains secularly tight and that we are not seeing yet layoffs, it means that yes, there is a softening. We are going back to conditions which were prevalent before COVID, but we are still in a state in which wage pressures can actually be persistent and persistently translate into price pressure. Of course, the last unemployment figure, inflation figures were positive, but it's always useful to read a single number in the wider context and more holistically rather than just a single number. And that means that, with significant growth, albeit less than probably what the market is expecting, and inflation will remain pretty strong, the appetite of the Federal Reserve to cut rates will be mute, in my view. And the same happens in Europe and the UK. In Europe, we had a rate cut by the ECB. It was broadcast extensively for weeks and weeks, so the market expected it. But a rate cut per se doesn't move the dial. A rate cut is relevant if it's part of a broader narrative, effectively signaling the start of an easing cycle. And because wage pressures in Europe are still pretty high, and inflation, especially in the service sector, remains pretty high, I'm not sure about the timing of this rate easing. And the same can be said in the UK, because we have similar job market restrictions. So I can speak a bit longer about this, but you might want to select some topics effectively.
Absolutely. So now we've got the macro outlook settled and we know what this sort of situation is. Let's look at what it's doing around asset prices and emerging risks. So talk to me about this macro impact on those areas of prices and emerging risks.
Sure. I actually like the word emerging risk, because I think the market is now pricing. Let me say this first. What happens in the US is the absolute driver of what happens in other economies, in the Eurozone, in the UK. Everyone is looking at the actions of the Fed and the price action in the US market to determine what happens on the other side of the Atlantic. I mean, there could be a bit of a divergence, but this is direction of travel. The main driver is what happens in the US. And what happens in the US is that the market are pricing a soft landing quite aggressively. If you look at what is implied by equity valuation, you have earnings which are expected to grow by around 17%, almost 20% in the next 1 year. And also, you have margin expansion, which is embedded in those earnings. And this is quite aggressive. The level of 17%, also because, over the past few quarters, you didn't have any growth at all. And in actual earnings. So earnings at the end is effectively revenues times margin. So you have to have an increase in revenues, but increasing revenues increases broadly by the GDP, and the GDP growth which is expected by the market is 2.4% in real terms, and you add another 3% of inflation, is let's say roughly 6%. So to get to 70%, you need to have another 11%, even more of margin expansion. And these are kind of extreme views. Even a growth at 2.4% at this point looks quite challenging because of what happened in the first quarter. The first quarter, you had a growth of 1.4%. In the second quarter, I've just checked the GDP Now indicator, which is, it's not the gospel, but it is a reasonable indicator of what the activity in Q2 is going to be. It's going to be 2%. So nothing close to the 3%, which is needed to averaging 2.4% by the end of this year. So there is an optimistic view on growth. There is an optimistic view on margin expansion, and of course, multiples which means effectively the term premiums are low. And this is a combination of very good scenarios, very good let's call it very good scenarios, which may actually not translate in reality. And the same is true in the bond market, because in the bond market you have again rates which have not moved significantly in 2024. We had a big swing in 2023, mainly dictated by the action of the US Treasury, the so-called QRAs. In 2024, you had kind of steady rate around 4.5%, is kind of a range trading. But effectively, the disappointment could be that the market won't see enough growth to justify equity valuations, but at the same time, there will not be any significant rate cut cycle that will benefit taking duration risk in the bond market. And this is a situation that also will translate in other economies, because what we have seen, For instance, when there was a significant price action in the US last year, the same price action was followed by 10 years gilts or 10 years bund, even if the macro conditions were different. And so we are in a situation in which, said very simply, equity looks overpriced, and bonds also do not seem to have significant room for capital appreciation, and that makes any allocator job much more difficult.
Interesting. So we've taken the macro, we've looked at macro, and then we've taken risk. So let's look at liquidity now. So there's a preference for liquidity. Is taking that risk rewarded?
Well, currently, I mean, from what I just said, currently, no, the risk is not particularly well rewarded. If you look at the term premium, the term premium is not observable. There are different ways of computing it. There is one indicator which is provided by the Fed. If you look at that, at least there is consistency in the time series. Might not be the perfect indicator, but at least you can see the time series, and time series tells you that term premium have decreased significantly over the past few years or decades, and now it's effectively zero, which tells you that taking duration risk doesn't pay you anything. So it is effectively saying that it's equivalent to invest in cash and roll the cash overnight, or invest in 10 years. And of course, then you have to apply a market view. Then you can say, no, I do believe that the Fed will cut more aggressively than currently priced, and that will give you some buffer for capital appreciation. But in fact, if you look at the future prices, I mean the short-term future prices, the market is more optimistic about the Fed, about the cuts. There are 4 to 5 cuts priced in the next 12 months, I believe. And this is even more aggressive than what the Fed has indicated. And for what I just said, because of the persistency of inflation and wage pressures, the Fed itself may be over-optimistic at this stage. So I cannot see a lot of value in that. And of course, this translates in all the other risk premium, because also the equity risk premium in a way is sensitive to what happens to term premium. And that's why I said that allocating between bonds and equities at this particular juncture it may prove quite challenging.
And my final question for you today, Corrado, is around the role of private assets. What are you seeing there, and what should people be looking out for?
Yeah, I mean, at Foresters, people that has followed us, that knows a bit about Foresters, they know that we have allocated quite a significant amount of the balance sheet to private asset, to alternative strategies. We have currently paused, mainly because we have done quite a bit over the past 5 to 6 years, and there is a balance between liquidity and illiquidity on our balance sheet, which need to be preserved. But on a strategic basis, if I were to speak, not constrained by the balance sheet, what happens on Foresters' balance sheet, I still see a significant role of private assets. I think this is now becoming a common understanding that there is a role of private assets, and especially for institutional investors like insurance company, pension fund. As an insurance company, at the end, we are not a hedge fund. We may take some tactical views, but in general, what we do is harvesting risk premia. And there are many. I mean, there is a term premium through duration, but as I said, it doesn't pay anything at this point in time. There is a credit risk premium, which is pretty compressed, I must say. And there is a liquidity risk premium, which is embedded in private assets, and it should be earned over time. And equity risk premium for insurance companies is a bit more is a bit trickier because of the capital absorption that it requires, and of course you can't have a balance sheet invested just in equity. But for insurance companies, there is this balance between this combination of illiquidity risk premium and credit risk premium that can be harvested over time. And it's true that private assets have grown significantly over the past 10 years. In a way, the market has not been tested against a proper recession. So all the numbers, all the performance numbers need to be taken with a pinch of salt, knowing that, if there's a big recession coming, which may last for months and for a few quarters, some of these assets, the performance of some of these assets will be impaired. But in general, it's difficult to see how these assets could be performed significantly worse than other assets during a recession.
There's so much to talk about. There's so much to think about. So if this has whetted your appetite, please do go to insuranceinvestor.com, follow the links, and register for the Insurance Investor event in September, where Corrado will be speaking on this topic with a full panel. Thank you so much for your time today, Corrado. It's been a pleasure to hear your thoughts, and looking forward to hearing more of them in September. Thank you very much for watching. My name is Andrew Betwain, and have a lovely day.